Hello, this is Tim Congdon, Chairman of the Institute of International Monetary Research at the University of Buckingham. It's late May 2021, and I'm giving the usual monthly video on monetary themes. And today I want to focus on the American economy and particularly the prospects for American inflation. Earlier this month, we had the April Consumer Price Index, which showed a rise of 4.2% in the last year. And this came as a great shock to people. And the question is, will the rise in inflation, which is now obvious and indisputable, is this going to be temporary? Will it persist for some time? Or could it even be permanent? And what I want to do in the next quarter of an hour, 20 minutes, is to discuss this theme and try and answer the question. The first thing I'm going to say here, in my view, should not be controversial, but it is. And this is that the reason for the upturn in inflation is the increase in money growth that we've seen in the United States in the last 18 months, 2 years. Inflation is caused by excessive growth of the quantity of money. What we had in 2019 was a pickup from figures around about 4% or so that had been the norm in the previous 7 or 8 years to 8.5%. And then in 2020, an extraordinary increase, particularly in the spring, when in the 4 months to June, the quantity of money rose by about 19%. And these have been the driving forces behind the upturn in inflation. We have been, if I may say so, correct in analysis of this situation. In two senses, we have identified the likely features of the transmission mechanism from money to inflation. Effects on asset prices first, coming through commodity prices and so on, like many other cycles of this sort. But what we've also done is to highlight that in the United States, the increase in money growth has been faster than elsewhere, and that logically should lead to a worse inflation problem in the United States, and that is what's happening. It's been a minority view to take. To some extent, we have to remember that we are a minority, and we have to point out that other people have got it wrong. Let's just go back to about a year ago, when we have the minutes of the Federal Reserve Open Market Committee, FOMC, saying that COVID-19 would mean disinflation over the medium term, with the need for action to counter that lasting for many years. And I've been a little bit unkind. There's a photo here of the Fed Chair, Jay Powell, welcoming the Fed Vice Chair, Richard Clarida, who is in effect the most important economist in the Federal Reserve. And they've just got it all wrong. What we said at that time was very different. I've included here in this framed kind of portrait what we were doing in spring 2020 to emphasize that we've got things right. I had, in fact, even on the 6th of April, sent out an email, which I'm going to quote. I said, does the Fed understand what it's doing? That's after this huge surge of money last March, April. At some point, the coronavirus crisis will be over. And what will happen then to the excess over normal money balances created by public policy in 2020 and early 2021? The answer is that, as in the aftermath of wars, an inflationary boom in the world's leading economy has to be the central forecast. It seems to me that a major increase in inflation due to this boom is inevitable. Whether that increase is to 5% or 10%, no one knows for certain yet. Well, we're at more or less 5%, and what I want to talk about in the next few minutes is focusing on that, where we're going exactly. But can I just say on this front that the FOMC still doesn't really seem to understand what's going on. The Federal Reserve doesn't really believe that inflation is caused by excessive growth of the quantity of money. It doesn't believe that at all. They don't talk about money in their research. And the FOMC minutes, this meeting of the 29th of April, it said, the staff continued to judge that the risks of the baseline projection for economic activity were skewed to the downside. That's just a few days before the 4.2% CPI figure was released. Now, I'm going to spend the next few minutes just trying to understand the prospect for inflation in the next few months in the United States. I wrote an article which appeared in the winter issue of a magazine called The International Economy. I wrote this some months back. And in that, I put a kind of box explaining what would happen to the annual rate of US CPI inflation on various assumptions about the monthly change through 2021. One line was assuming a monthly increase of 0.2%. The other, which I found much more likely, was a monthly increase of 0.45%, almost 0.5% a month, because of what was going on in the economy. And you'll see that I actually put there for April 4.1. In fact, it's 4.2. Now, the next CPI release is the 10th of June, obviously relates to May. May 2020, we had a fall in the CPI of 0.1%. So we will go through 5% if the increase in the month is 0.7% or more. Now, I obviously don't know what it's going to be, but if we assume, as I did here, that it's more likely to be kind of about 0.4, 0.5%, then we get the CPI number up towards about 4.7, maybe 4.8%, a kind of number. We've almost got to 5%. But let's just then look further through 2021. There were quite large rises in the CPI last June and July. And in my view, it's more likely we're going to go through the 5% figure in the autumn, when we had some relatively small increases or no increase at all in 2020. But I would say we're likely to go through 5% on the US CPI number later on this year, possibly in the next few days, more likely to be in the autumn. That's kind of what's driven by the profile of the index last year and this year. What's going on in underlying terms? Well, let's look at some business surveys. Here I'm looking at the Institute of Purchasing Management survey, the IPM survey for services. And let me, if you'll forgive me, just read this. It says that this is the value. It's the rate of expansion was the sharpest since data collection for the series began in October 2009. Doesn't really fit with those FOMC minutes, does it? And inflationary pressures continued to mount in May as rates of increase in input prices and output charges quickened to the steepest on record. The manufacturing PMI, different surveys for services and manufacturing. Final sentence: companies made efforts to pass higher cost burdens onto clients, causing output charges to rise at the steepest rate on record since 2009. What we've had, therefore, in the USA since the money explosion last spring is booming stock market, strong housing market, commodity price inflation, very buoyant business surveys. What we're now getting also is signs of wage increases. Now, can I just, the research at the Federal Reserve is New Keynesian. The New Keynesians do pay attention, they're supposed to, what's happening in the labour market. Labour market's always a lagging market. It's not a good way of forecasting the economy, but they do look at that. McDonald's has just announced they're going to raise wages by about 10%. The Bank of America has made an announcement that they too are going to be raising the minimum pay through to 2025 by about 25%. So look, this is a very classic inflation episode. There's nothing particularly this sort of thing has happened in the past. There's nothing very unusual about it. It fits perfectly well with the kind of analysis I've done over my career, 40-year career, of episodes of this sort. And it's amazing to me that the Federal Reserve research staff cannot see this. The answer to our question in the way is very simple. Our question is, will the rise in inflation be temporary? Will it be persistent? Will it be permanent? It all depends on the rate of growth of the quantity of money and the quantity of money broadly defined. I'm not interested in M1 and the base and the central bank balance sheet. It's the quantity of money broadly defined that matters, the quantity of money held by private sector non-bank agents, households, companies and financial institutions. Okay. What I'm going to do here is to look at 3 different scenarios, if you like. I don't know what's going to happen, of course I don't, but we can get a sense for likely outcomes by looking at different paths for the growth rate of money in the next few years. And that will then help us when we track these figures on a month-by-month basis. Let's look at this chart, which goes back to the early 2010s. You can see it's of the annual rate of growth of money and also the 3-month annualized growth rate of money. You'll see that period of stability through the 2010s, very benign period for macroeconomic outcomes, very low inflation, very steady growth, immaculate in many ways. And then the leap in money in a little bit in 2019, but even more in 2020. The annual growth rate moving up to over 20%. What I've done here is to assume that we return to the kind of pre-2019, pre-COVID pattern. That is my first case. I hope that is what happens. I'll talk about it in a bit more detail in a few minutes. But we've got, that's with 0.3% a month increase in broad money, a little bit under 4% a year, which, by the way, is what Milton Friedman recommended for the United States back in 1959. There's then two alternative scenarios. One is with 0.6% a month, and then the other one is with 0.9% a month. Obviously, 0.6% a month is like over 7% in a year, and 0.9% is more like 12% in a year. Now, what I'm doing in what I'm about to say is applying a theory that I've used often in the past. It's quite important to understand that there isn't a mechanical link between money and inflation. The link is very much medium term over a period of 5, 6, 7 years. Period 5, 6, 7 years, you will tend to see that money growth is equal to the increase in nominal GDP minus, say, 1% or so, and the rate of inflation is simply the increase in nominal GDP minus increase in real GDP. If we have 0.3% a month growth of money from here, that won't stop inflation straight away. Inflation will roll on for a bit, so you'll get inflation above the rate of growth, the quantity of money, a squeeze on real money balances, which will hit asset prices and economic activity. We'll get inflation back down to the kind of numbers seen in the 2010s, more or less price stability, benign outcome, but there may well be a recession in late 2022 and early 2023. Okay, that's to offset the current kind of boomy type conditions we see in the United States, and it's true enough that all the people who had jobs back in early 2020 haven't found jobs yet, but actually the economy is bursting at the seams. There's terrible shortages of labour reported in business surveys and so on. If we get increase of say 0.6% a month, then the inflation rate is not going to come back to the kind of numbers seen in the 2010s. We are going to get higher inflation on a sustained basis, on a sustained persistent basis, not numbers up in the double digits, but numbers more like, say, 3, 4, 5% a year. There will be a slowdown, but not as marked as with the 0.3% a month case. All right, so I wouldn't say there's the same kind of recession risk, but there will be this persistent inflation through to the medium term. Can I just say here, by the way, that I'm sufficiently Keynesian to accept that there's a short-run trade-off between growth and inflation, between employment and inflation. I'm a monetarist, but basically I can accept that. I don't have any problems with that. What about the 0.9% a month case? Obviously, in this case, here we have money growth running up to, even when the world settles down, up into double digits. Then in this case, we would have, in the 5 years, 2019 to 23, an average growth rate of money of 13%, and I'm afraid we really are into double-digit inflation territory. Which of these three outcomes is going to turn out in practice? To get a sense of this, we need to look at what's happening to bank balance sheets at the moment. And here, I'm going to show a picture which may puzzle you. It's a straight line. This is a line for the American banking system's non-cash assets, mostly loans to the private sector, in the last year. It hasn't changed. The point of this is that most of the growth of money, most of the growth of banks' assets, this has been the result actually of what the American state has been doing, both the American federal government and the Federal Reserve. The federal government, because it had a budget deficit, which it's been financing partly from the banks, the Federal Reserve, because it's been buying assets from the non-bank public. That has increased banks' cash reserves, which have increased sharply in that period. On the other side of the balance sheet, there's been an increase in deposits, money held by the non-bank private sector, which is then causing the boom in the economy and so on. What will happen in coming quarters? The Federal Reserve will stop its asset purchases at some point in the next 3 to 6 months. If they don't, they really need their heads examined. But that is coming up. That's clearly implicit in recent events. That will reduce the rate of money growth. The private sector may start to borrow again, and this is really what we must watch out for. If the private sector starts to borrow $50, $100 billion a month from the US banking system, that straight line will start to move upwards, and then that will push up money growth. So that's got to be monitored. And what we have, of course, is the large US budget deficit running at around about $250 billion a month. To the extent that that is financed from the banks, say it's financed to the extent of half of that from the banks, then that by itself adds about 0.5% a month to the quantity of money. Look, I don't know exactly what's going to happen, but what I would say is that I would expect us to get back towards the 2010s kind of numbers when we had this amazing macroeconomic stability and lower inflation. I would expect that as my, not essentially, but kind of like my hope and an expectation, but hardly conviction. It may well be in practice that US policymakers, we have instead this kind of muddled sort of outcomes. The budget deficit continues, they can't decide what they should do on asset purchases or sales, and we get this more like 0.7 to 0.9%. We really are in inflation trouble of a kind we haven't seen since the 1970s. Let me conclude by saying that in many ways, I can gloat. I've got this right. I've got it right in spades. But it's very sad. The theory I hold is not complicated. It has been a standard theory for decades. The Federal Reserve Research Department doesn't know what it's doing. It's as bad as that. I don't know what's going to happen. I think we had to be prepared for the likelihood that this kind of 3, 4, 5% inflation may be around for some time. I hope we get back to what we had in the 2010s. Thank you.